All right, today we are diving into a real head scratcher. It's a puzzle that's got a lot of people talking. You've probably seen the lines, right? The massive queues for CheGT. I mean, the brand is absolutely on fire all over the world. And yet, the stock? It's been a complete and utter disaster. So, how can a brand that everyone seems to love be a stock that Wall Street seems to hate?
So let's get right into it. This is the central mystery we're trying to solve. Since its big debut on the NASDAQ, the stock has basically been in a freefall. And that disconnect, what you see with your own eyes on the street versus what you see on the stock chart, that's what makes this story so fascinating.
I mean, just look at this. On one side, you've got a viral sensation. Chaji is popping up everywhere, expanding like crazy, with a customer base that is fiercely loyal. And then on the other side, you have a stock chart that just looks like it fell off a cliff. So what is really going on here?
To get to the bottom of this, we're going to borrow the playbook from one of the greatest investors of all time, the legend himself, Peter Lynch. Now, Lynch's whole thing was finding these amazing companies that the market had just completely misunderstood, and honestly, Changi feels like a textbook example.
See, Peter Lynch always said that the company's story is way more important than its day-to-day stock price. A business isn't just numbers on a screen. And believe me, Chaji's story, it starts with one of the most incredible founder journeys you'll ever hear.
Yeah, this is not a story that was cooked up in some fancy business school boardroom. The founder, Zhang Jinji, was orphaned at 10 years old. When he got his first job in a tea shop at 17, he couldn't even read. He actually taught himself to read by memorizing the characters on the ingredient packages. He literally built this global empire from nothing. This is exactly the kind of gritty, passionate, founder-led story Lynch would have absolutely loved.
And you know what? When we run Chagi through the rest of the Lynch checklist, it just keeps passing with flying colors. The story's powerful. It's a product you can actually see and understand. And then you look at its valuation. The PEG ratio, which basically compares a stock's price to its growth rate, is around 0.5. Peter Lynch called that a buyer's paradise.
Okay, now let's switch gears and talk about the financials, because this is where the story goes from interesting to truly unbelievable. If we just ignore the stock price for a minute and peek inside the company's bank account, we find something, well, remarkable.
The company is sitting on a mountain of cash. We're talking nearly $1.3 billion. And this isn't from some fancy financial trickery. It's the result of a massively successful IPO and a really smart, profitable franchise model.
And this right here, this just perfectly illustrates their financial strength. While you have tons of other companies out there getting crushed by high interest rates, Chigi has zero, and I mean not a single dollar of interest-bearing bank debt. It makes their balance sheet an absolute fortress.
So what does all that cash actually mean for the stock price? Well, think about this. If you take their total market value of about $1.9 billion, and you just subtract the $1.3 billion in cash they have sitting in the bank, the market is basically saying that the entire global business, all 7,300 stores, the brand, the supply chain, the whole shebang, is only worth about $610 million.
Let me put it another way. A full 2/3 of the current stock price is just backed by cold, hard cash in the bank. You're essentially paying for the cash and getting this fast-growing global tea business for an incredible discount. It doesn't add up.
Okay, so if the story is great and the balance sheet is a fortress, why on earth did the stock collapse? Well, it all comes down to one big, flashing red flag that has investors running for the hills. And that's trouble in their home market.
The Chinese tea market has become a brutal price war, and to protect its premium brand, Cheji hasn't been cutting prices. The result? Its same-store sales, that's sales from stores open for at least a year, have just plummeted. At one point, they fell by a staggering 23%. For a growth company, that is a terrifying number. But, and this is a huge but, here's the twist. While China is slowing down, the international story is exploding. Overseas sales are up over 75%. Places like Malaysia and Singapore are absolutely booming, and they just announced they're moving into South Korea. Get this, the average store in Singapore actually makes 5 times more money than the average store in China. So what we have here is this perfect tug of war, right? A struggling home market versus a booming international business. So let's see how the so-called smart money, the big institutional funds, are reacting to all this conflicting information.
And they are completely split. You have really sophisticated funds like Coatue getting cautious, trimming their position. But at the exact same time, you have giants like UBS and Morgan Stanley who are looking at this price drop and seeing a massive buying opportunity, and they are dramatically increasing their stakes. There is absolutely no consensus here. So it all boils down to this. We're at a classic standoff. You've got a business that looks incredibly cheap on paper with a balance sheet like a fortress, but it's facing some very real, very serious concerns about slowing growth in its most important market.
And this whole debate is about to come to a head because everything, and I mean everything, hinges on the company's full-year earnings report, which is coming up on March 31st, 2026. This call is going to set the tone for the entire year ahead.
So when that report comes out, you need to listen for 3 very specific things. Number 1, has the sales decline in China finally hit bottom? Has it stabilized? Number 2, what are their real concrete plans for international growth? And number 3, the big one, what are they going to do with that $1.3 billion in cash? Any mention of a share repurchase where they use that cash to buy back their own stock could be a massive, massive catalyst.
All right, full disclosure here, I love the product. I see the lines myself, I get the deep value argument here. And personally, I wouldn't mind picking up some shares at these levels. But, and this is important, this is not financial advice. You have to do your own research, always. The big question for the market is whether Changi is a melting ice cube or a coiled spring. And on March 31st, we might just get our answer.